Hello, everybody, and welcome. So, what we're looking at here is that on January 1st, Almont Company sold 12% bonds having a maturity of 500,000 for 537,907.37, which provides the bondholders with a 10% yield. So, the one thing we don't know here is we don't know what the term of the bond was. So, I can't use present value tables to kind of go back through and calculate it, but we can just kind of go through and kind of take a look at this in terms of how to do it. So whenever I'm doing a bond at a premium, I'm always going to be debiting cash for the amount of the cash proceeds, which is 537,907.37. And then I'm going to be crediting bonds payable. Bonds payable is always at the face amount of 500,000. And my difference here is going to be a premium on bonds payable. My premium on bonds payable will just be the difference between the cash proceeds and the face value of the bond. Okay. So the next thing we need to go through and do is the interest is being paid at December 31st. And actually, I made a mistake here. The bonds are dated January 1st. They mature on January 1st, 2025. So 2020, 2021, 2022, 2023, 2024. So this is a 5-year bond. If we were to go through and see how did they come up with this amount, what we would do is we would say to ourselves, okay, in terms of the bond valuation, the face value of the bond is 500,000. So, however, when a bond is being repaid, is like I treat it like an interest-only loan. So I have to pay interest every year, but then when the bond matures, I have to pay the principal back. So the way that I'm going to do this is for the lump sum is I'm going to go to the present value of a dollar table. So I'm going to go to present value of a dollar. I'm going to use the number of times the interest being paid, or 5 periods. And this is going to be at the effective interest rates. So, or 10%. So it's giving the 10% yield refers to the effective rate, but the market rate of interest, which is what we use over here. So the number of periods is 5. And at 10%, this is 0.62092. So the present value of the principal is going to be 310,460. The other component, though, of the bond is going to be the interest component. To get the interest paid, they're 12% bonds. So the cash paid for interest this is going to be 500,000 times 12%. For the interest payments, though, I don't use the present value of a dollar. Present value of an annuity of a dollar. 5 periods at 10%. That's the number of times interest is being paid. So my present value of the interest, 5 periods, 10%, it's 3.79079. And when I multiply these two together, when I add these up, that's how I'm getting 537,907. I'm off by 3 cents, but that's how they're coming up with that number. Very, very important. Okay, so to record bond issuance. Now, okay, so prepare a schedule of interest and the bond amortization for 2020 to 2021. And it's also asking me to record the interest payment and the amortization for 2020 and then 2022. So this is my journal entry at the date of the bond issuance. At 12/31/20 and 12/31/22, whenever I'm paying interest and I'm in a premium situation, the journal entry never changes. I'm going to have a debit to interest expense. I'm going to debit premium on bonds payable because I need to take that premium down to 0. And then also it's going to be the same over here. And I know that every single time I'm paying cash of $60,000. Doesn't make a difference. But what I need to figure out here, though, is what does the interest expense look like? So let's go take a look at how this works. So what I'm going to do here is I'm going to have my bond carrying value. My bond carrying value is what I have over here on my balance sheet. So my carrying value, and we'll put it all the, basically put the dates here. We've got 5 payments. And what we're going to try to figure out is what is our interest expense. So my bond carrying value is what's on my balance sheet initially. And this is going to be $537,907. The premium gets added to the bond payable to show the total carrying value. So my interest expense, my interest rate is 10%, and I'm using the market interest rate. So my interest expense is going to be $53,790.74. What I'm then going to do is I'm going to compare this to my interest payment. My interest paid is $60,000. The difference of this is going to be my premium amortization. So my premium amortization is going to be $66,209. And my ending carrying value is going to be my beginning carrying value less my premium amortization, or $531,698. Remember that I want my carrying value to go, if I'm in a premium situation, I need this to go down to 0, right? Because when I pay back the bond, it needs to be at the face value. So then over here, my ending becomes my beginning for the following year. My interest rate never changes. Once I set that rate for interest, I always use that same market rate. So my interest expense for the second year is going to be slightly less. Interest paid is still going to be at $60,000. My premium amortization is going to be slightly higher. And so my ending carrying value is now going to be at $524. And if we carry this all the way through, we should get this down close to about $500,000 by the end of it. So you can use the Excel sheets on the CPA exam. Very good idea. Okay, so my interest expense for 12/31/20 is going to be $53,790. My premium amortization, $6209. 12/31/22. Here is my interest expense, and here is my premium amortization. And what you'll notice here is that by amortizing this premium, we're eventually getting this down to 0 when the bond's going to be paid off. So that is exercise 1410, and I look forward to seeing you on the next video. Have a great one.